They told you to go to college no matter what it cost, to buy a house as soon as you could afford the down payment, and to save your money in a piggy bank until you were old enough for a real account. They told you credit cards were dangerous, that you should never talk about salary with coworkers, and that a steady job with benefits was the only path to security. Some of those lessons sounded wise. Some of them were half-truths wrapped in outdated thinking, and some of them have quietly cost you thousands of dollars without you ever realizing it. This video counts down 15 of the worst money lessons schools across the country have been teaching for decades. They shape how you spend, save, borrow, and plan your entire financial future. After watching, you'll know which rules to ignore, which traps to avoid, and how to think about money in a way that actually builds wealth instead of just keeping you busy. Let's get into it. Number 15 is the idea that you should never use credit cards because they're a trap that will ruin your life. Schools love to warn students about credit card debt, and yes, carrying a balance at 20% interest is a disaster. But the lesson stops there. It never explains that credit cards, when used correctly, are one of the most powerful financial tools you can own. If you pay off your balance in full every month, you pay zero interest. You also build a credit history which affects your ability to rent an apartment, buy a car, get a mortgage, and sometimes even land a job. Employers and landlords check credit scores. If you avoid credit cards entirely, you might have no score at all, which looks worse than a low score in many cases. You also miss out on fraud protection. If someone steals your debit card and drains your checking account, that money is gone until the bank investigates, which can take weeks. Credit card fraud is the card company's problem, not yours. You dispute the charge and move on. Then there are rewards. Responsible users earn cash back, points, or miles on every purchase they would have made anyway. Over a lifetime, that adds up to thousands of dollars. The real lesson should be this: credit cards are tools. Tools are only dangerous if you don't know how to use them. Schools skip the second half. Number 14 is the belief that renting is throwing money away and you should buy a house as soon as possible. This one sounds like common sense. Rent goes to a landlord and builds nothing. A mortgage builds equity, but the full picture is more complicated. When you buy a house, you pay interest, property taxes, insurance, HOA fees if applicable, maintenance, and repairs. In the first years of a mortgage, almost all your payment goes to interest, not equity. If you sell within 5 years, closing costs and realtor fees often eat any gains. Renting gives you flexibility. You can move for a better job, leave a bad neighborhood, or avoid being trapped in a house you can't afford to maintain. Homeownership also ties up your money. That down payment could have been invested in index funds, which historically return more over time than home equity does. Real estate can be a good investment, but only if you plan to stay put, can afford the hidden costs, and buy in a market that appreciates. Treating a house as the automatic next step is how people end up house poor, stuck in a place they hate, or underwater when the market turns. The lesson should be, buy a house when it makes financial sense for your specific situation, not because someone said renting is waste. Number 13 is the idea that you should save money in a savings account and let it grow. This lesson was great in 1985 when savings accounts paid 5 or 6% interest. Today, most big bank savings accounts pay less than 0.5%. Inflation runs around 3% most years. That means your money loses value just sitting there. If you have $1,000 in a savings account earning 0.1%, you gain $1 in a year. Inflation eats $30 of purchasing power. You're going backward. High-yield savings accounts exist and currently pay between 4 and 5%, but schools never mention them. Money market accounts, treasury bills, and certificates of deposit also beat standard savings rates. Even better, investing in a diversified portfolio of index funds historically returns 7 to 10% per year after inflation. Keeping all your money in a regular savings account is not safe. It's slow wealth erosion. You need an emergency fund, and that fund should sit somewhere accessible and liquid, but it should earn real interest. Everything beyond 6 months of expenses should work harder. Schools taught saving as an end goal. Saving is just step one. Number 12 is the lie that student loans are good debt and you should borrow whatever you need to get a degree. Schools push college as the only path to success, and they never talk about return on investment. Not all degrees pay the same. If you borrow $100,000 for a degree that leads to a $30,000 a year job, you will struggle for decades. Private student loans come with variable interest rates and fewer protections than federal loans. Federal loans offer income-driven repayment and forgiveness programs, but private loans offer nothing. Some students graduate with debt they will never pay off, watching interest pile up while they make minimum payments that barely touch the principal. The lesson should be: borrow only what you need, choose a degree with clear earning potential, apply for every scholarship and grant available, work part-time, and consider community college or trade school. Trade electricians, plumbers, and HVAC technicians often earn more than people with bachelor's degrees and graduate with zero debt. Debt is only good if the asset it buys generates more value than the cost of the loan. A degree can do that, but only if you plan smart. Number 11 is the idea that talking about money is rude, especially your salary. Schools never teach salary negotiation. They never explain that companies have salary ranges and that your coworkers doing the same job might make 20% more than you simply because they asked. Staying silent about salary helps employers, not employees. If no one talks about what they earn, no one knows they're being underpaid. Women and minorities get hit hardest by this culture of silence. Pay gaps persist because people don't compare notes. Glassdoor, PayScale, and Levels.fyi exist because workers finally started sharing data. When you know what the market pays, you have leverage. When you negotiate, you're not being greedy. You're being smart. The same goes for discussing financial mistakes, debt, budgeting, and investing. Keeping money conversations taboo keeps people ignorant. Schools taught shame instead of strategy. Number 10 is the belief that a college degree guarantees a good job and financial security. For decades, schools hammered the message that college was a golden ticket. Get the degree, get the job, live the dream. Reality looks different. Millions of graduates work jobs that don't require degrees. Underemployment is rampant. A degree signals you can finish something, but it doesn't prove you have skills employers actually need. Meanwhile, the cost of college has exploded. Tuition rose faster than inflation, faster than wages, faster than healthcare. Students borrow heavily based on a promise that no longer holds. At the same time, skilled trades face worker shortages. Electricians, welders, dental hygienists, and radiation therapists earn solid livings without spending 4 years in lecture halls. Coding boot camps, certificate programs, and apprenticeships offer faster, cheaper paths to well-paying work. The lesson should be: education is valuable, but the format matters. Evaluate cost versus expected income. A degree is not a guarantee. Skills, hustle, and smart choices matter more. Number 9 is the idea that you should get a car loan because everyone finances cars and it's normal. Schools never taught the true cost of car ownership. A car loses value the moment you drive it off the lot. Financing amplifies the loss. If you borrow $30,000 at 6% interest over 5 years, you pay nearly $5,000 in interest alone. Add insurance, gas, maintenance, and registration, and that car costs you far more than the sticker price. Worse, many people roll negative equity from their old car into a new loan, borrowing more than the new car is worth. They end up underwater, trapped in a cycle of loans. Buying a reliable used car with cash or saving up and paying cash for a modest new car saves thousands. Yes, it takes patience. Yes, it might mean driving something boring for a while, but it keeps your money working for you instead of paying interest to a bank. Loans should finance assets that appreciate or generate income. A car does neither. The lesson should be: avoid car debt if possible, and if you must finance, keep the term short and the amount small. Number 8 is the myth that you need to buy whole life insurance as an investment. Some schools invite insurance salespeople to teach financial literacy classes, and those salespeople pitch whole life insurance as a savings vehicle. Here's what they don't say clearly. Whole life insurance is expensive, complicated, and almost always a bad deal for young people. Term life insurance is cheap and straightforward. You pay a small premium, and if you die during the term, your family gets a payout. Whole life insurance costs 10 times more because it includes a cash value component that grows slowly and comes with fees. The returns are terrible compared to investing that same money in index funds. Insurance agents love selling whole life because commissions are huge. If you need life insurance, buy term coverage and invest the difference. If you don't have dependents, you might not need life insurance at all. Schools never explain that insurance and investing are separate goals. Mixing them usually means you lose on both. Number 7 is the belief that you should always pay off your mortgage early because being debt-free is the ultimate goal. This sounds responsible, and for some people it makes sense emotionally, but financially, it's not always smart. Mortgages usually come with low interest rates, especially if you locked in a rate below 4%. If your mortgage rate is 3% and you can invest money and earn 7%, you come out ahead by investing instead of paying extra on the house. Paying off your mortgage early also locks your money into an illiquid asset. If you need cash for an emergency, you can't easily pull it back out without selling the house or opening a home equity line of credit, which costs money and takes time. Diversification matters. Putting all your extra money into your house concentrates your wealth in one asset. If the market crashes or your neighborhood declines, you lose big. The lesson should be, run the numbers. Compare your mortgage rate to expected investment returns. Consider your risk tolerance and liquidity needs. Debt isn't automatically bad if the cost is low and the money works harder elsewhere. Number 6 is the idea that you should pick a career based on passion, and the money will follow. Schools love inspirational messages about following your dreams. Guidance counselors ask what you love, not what pays. The result is a generation of people with degrees in fields that don't hire or don't pay. Passion is great, but passion doesn't pay rent. The job market doesn't care about your feelings. It pays for skills that are in demand. If you love something that doesn't pay, you can still do it as a side project or hobby while earning a living doing something practical. The smartest move is finding overlap between what you're good at, what you enjoy enough to tolerate daily, and what the market values. That's where sustainable careers live. Passion without income becomes bitterness. Income without any satisfaction becomes burnout. The balance matters. Schools skipped the practical side and left students thinking they failed if they didn't love their job every single day. Number 5 is the belief that investing is only for rich people and you should wait until you have a lot of money saved before you start. This keeps people on the sidelines for years. The truth is that time in the market beats timing the market. Compound growth needs time to work. If you start investing $100 a month at age 25, you'll have hundreds of thousands more at retirement than if you start at 35, even if you invest larger amounts later. Apps and brokerages now allow you to start with tiny amounts. You can buy fractional shares of stocks. You can open a Roth IRA with no minimum. Index funds let you own a piece of the entire market without picking individual stocks. The barrier to entry has never been lower. Schools taught that investing was complicated and risky, something you did after you figured everything else out. The real lesson is, start as early as possible, even if it's small. Automate it so you don't have to think about it. Let compound interest do the heavy lifting. Number 4 is the idea that buying name brand products is always better and worth the extra cost. Schools don't explicitly teach this, but the culture around school does. Kids learn brand loyalty early. They see logos on backpacks, sneakers, phones, and laptops. The message sinks in. Better brands mean better quality and higher status. Sometimes that's true. Often it's not. Generic and store brand products are frequently made in the same factories as name brands, with the same ingredients or materials, just different packaging. You pay extra for marketing, not quality. This applies to groceries, medications, electronics, clothing, and more. Over-the-counter pain relievers are a perfect example. The generic ibuprofen has the same active ingredient as the name brand, but costs half as much. Same with allergy medicine, antacids, and vitamins. Clothing is another trap. A plain white t-shirt from a discount store can last just as long as one with a designer label that costs 10 times more. The logo doesn't make the fabric better. It makes the price higher. The lesson should be, judge products on performance and value, not branding. Test the cheap version first. If it works, keep buying it. Stop paying for someone else's advertising budget. Number 3 is the myth that you need a financial advisor to invest and manage money. Financial advisors can be helpful, but they're not required, and many charge fees that eat into your returns. If an advisor charges 1% of your assets annually, that's a huge drag over decades. A $1 million portfolio loses $10,000 a year to fees. Compounded, that's hundreds of thousands of dollars over a lifetime. Index funds and robo-advisors charge a fraction of that. You can build a solid portfolio with 3 funds: a total stock market index, a total international stock index, and a total bond market index. Rebalance once a year. That's it. You don't need someone in a suit to do that for you. If your situation is complex, trusts, estate planning, business ownership, tax strategy, then yes, pay a fee-only fiduciary advisor by the hour. But for most people, basic investing is simple and cheap if you learn the basics. Schools never taught those basics. They left students thinking finance was a mystery only experts could solve. Number 2 is the belief that emergency funds should sit in a checking account, because you might need the money instantly. Checking accounts pay no interest. Emergency funds should be accessible, but they don't need to be instantly available in the same account you use for groceries. High-yield savings accounts and money market accounts pay real interest and still let you transfer money within a day or 2. That's fast enough for almost any emergency. If your car breaks down or you lose your job, you're not going to fix it in the next 10 minutes. You have time to move money. Some people keep a small buffer in checking, maybe $1,000, and park the rest of their emergency funds somewhere that earns 4 or 5%. Over time, that's real money. A $10,000 emergency fund earning 4% makes $400 a year. In checking, it makes 0. That difference compounds. The lesson should be, keep your emergency fund liquid, but make it work. Every dollar should have a job, even if that job is just sitting there in case something goes wrong. Number 1, the worst money lesson schools ever taught is that hard work alone will make you financially successful. This is the biggest lie. It sounds inspiring. It feels fair. It's deeply embedded in school culture, work ethic lessons, and motivational posters on classroom walls. But it's not true. Hard work matters, but it's not enough. Plenty of people work 2 jobs, long hours, physically exhausting labor, and still live paycheck to paycheck. Effort doesn't automatically convert to wealth. What matters more is working smart, understanding leverage, learning high-income skills, building systems, and making strategic financial decisions. A teacher can work hard for 30 years and retire with a pension. A software engineer can work fewer hours and retire a millionaire because the market values their skill differently. A business owner can build systems that generate income without trading time for money. The janitor working 70 hours a week works harder than the CEO, but the CEO understands equity, negotiation, tax strategy, and capital. Schools never taught that. They taught compliance, punctuality, and effort. They didn't teach negotiation, investing, entrepreneurship, or financial literacy. They prepared students to be good employees, not wealthy individuals. The lesson should be, work hard, yes, but also work smart. Learn skills the market pays for, negotiate, invest, build multiple income streams, understand taxes, create leverage. Hard work is the floor, not the ceiling. Let's recap the big ones. Schools told you credit cards were traps, but they're tools if you use them right. They said renting was waste, but buying a house isn't always smart. They pushed you to save in accounts that lose to inflation and borrow for college without checking if the degree would pay off. They taught you not to talk about salary, which kept you underpaid. They acted like a degree guaranteed success, a car loan was normal, and whole life insurance was smart. They said pay off your mortgage early no matter what, follow your passion and money will follow. Wait until you're rich to invest, and trust that hard work alone would carry you to wealth. Every one of those lessons was incomplete, outdated, or flat wrong. You weren't taught how money actually works. You were taught how to follow instructions and stay in your lane. Now you know better. If this video made you rethink even one money habit, drop a comment and tell me which lesson surprised you most or which one cost you the most money. Share this with someone who's still stuck believing the old rules. Let's stop passing down bad advice and start building real wealth.